today. To kick it off, I would like to introduce our keynote speaker. Nicolas is the co-founder of DataTrek Research, which is an industry-leading market research provider. Nick has over 30 years of experience on Wall Street in equity research, money management, and investment banking. He's here to speak on some of the key trends he sees in the markets today, and his comments, as we could see, could not come at a better time with everything going on in the markets. So without further ado, I would like to welcome Nicolas.
Good morning, all. As you heard, I've had quite a lot of variety in my career on Wall Street. But I want to start the conversation today with something that happened to me about 20 years ago. And when I was working for Steve Cohen, who most of you might know is the inspiration for the fellow who's in billions and owns the New York Mets. And I spent 3 years working for him at SAC Capital as a trader and portfolio manager. And the old SAC is not anything like what Point72 is today. It was a much smaller organization, and the entire team fit in one room, about the size of maybe these 5 or 6 tables over here, a very small room. And around this time in 2001, 2002, during the middle of the bear market, I was sitting opposite a team of traders that allocated about $100 million of capital, and their P&L swings were astounding. They could be up $30 million in a day, down $30 million in a day, routinely. And it was just crazy to watch, but they ended up always making money every single week, and that was the old SAC approach, was make money, if not every day, then every week, regardless of market conditions. So one day I walk in a little bit early, like around 6 a.m., and the team across from me is already in place, and I look at the P&L because we could see everybody's P&L intraday and overnight on our screens. And they're down like $55 million on a $100 million pad. And one guy is sitting at his desk, dry heaving into a wastepaper basket. The other guy's in the bathroom and won't come out. And Steve comes in, he sees these guys are down half their pad, and the market opens, and eventually the two of them are kind of just sitting and huddled up in their corner. And Steve gets up from his desk and walks over to them, and the room goes silent because these guys are going to get fired right now. Steve's going to explode on them. It's going to be an amazing thing to watch. That's the way the room operated. And he walks over and he sits down in the chair next to them, and he's kind of slumped over, and he looks at them and says, "You're making this harder than it has to be." And the room is dead silent. Everybody can hear him. And he says, "Do you understand what I'm telling you?" And the guy said, "Yeah, okay, good." Steve walks back to his desk, leaves him alone. The guys literally sold everything on their pad, took every loss, wiped the slate clean, and started trading again from the bottom up. And the way we were trained at SAC was when you join the firm, you get a $10 million pad, and your only goal is to make $1,000 a day. And once you can do that for a month, they say, okay, make $1,500 a day, every single day. If it's 1 trade, 10 trade, 20 trades, doesn't matter. Just make that number, and then you grow from there. And that's what these guys did. They went back to basics. 1 or 2 positions, then 2 to 4 positions. And by the end of the month, they had made back the $50 million they had lost, just going back to basics. And that always really struck me. And I think about that day all the time when markets are volatile. Because what happens is we all, as kind of thinking people, make things a lot harder than they have to be. And so that's in the spirit of that, I just wanted to give you a couple of ideas of how I see the most simple facets of this market and what we should be thinking about them now. So for example, let's just go back to basics. What do stock prices do? They discount future earnings, current and future interest rates, and the uncertainty around those factors. And that's it. They don't discount politics, they don't discount war, they don't discount anything. They discount those 3 things and nothing else. So with that as a bedrock, let's just talk about what's the market telling us right now. And the first thing I'll tell you, just keeping it simple, is I read a lot of commentary that says, oh, there's bear markets and it doesn't matter and it's just normal. This market is not normal. If you look at the standard deviation of returns over the last 100 days, it's 1.5% on the S&P. So that band, 1.5%, is one standard deviation. The normal number is 1%. The only times it's been higher than this in the last 20 years is the financial crisis, right after the financial crisis, and the pandemic crisis. And that's it. So don't believe anybody that tells you, oh, this is just normal market volatility. It is not normal. Look at yesterday, look at today, look at the last 2 weeks. The volatility is getting higher, not lower. We're not yet reverting back to a normal mean. So understand that we are in a very unusual situation and will continue to be so for a while. Now, why is that? The biggest thing I can tell you is, and I'll put this to you in the form of a question. The S&P 500 earned $55 a share in earnings in Q4 and Q1. Okay, that's the baseline. Record profits, by the way. How many of you think the S&P is going to earn, say, 9 or 10% more than that in the back half of this year? Anybody believe that? Okay, well, you're all scarred by what's happened in the market, so I can understand why. But here's the problem. Those are the Wall Street estimates for the fourth quarter. Wall Street has the S&P going from $55 a share to $60 a share in earnings by the fourth quarter. That was the current expectation coming into yesterday, coming into the last week. And that is the essence of the problem. Because as you all correctly intuit, there is absolutely no way the S&P is making 10% more in Q4 than it did in Q1 with the Fed raising rates and everything else going on. So that's why you're seeing the market do what it's doing the last couple of weeks. The market has finally come to the realization that earnings are not going to be as high as people had hoped. And that's sort of the most simple thing I can share with you about why the volatility is happening. It's not about the consumer per se. It's not about, what's going on anywhere else in the world or politics or midterms. It's none of that. It's really simple. Earnings aren't going to be as high as expected. And that's it. And that's why the market imploded yesterday. Because when Walmart and Target come and give negative earnings guidance but give positive revenue guidance, which is what Walmart did, we've got a margin problem and a profits problem. And it's as simple as that. Now let's move on, because there's obviously other things. Fed policy is the next thing. The befuddling thing about Fed policy is that nobody knows how high rates are going to have to go to kill inflation. That is as simple as it gets. Chair Powell says it, every Fed speaker says it, and any emotionally honest investor has to understand that there is no endpoint to this process until inflation comes down. So let's talk about what's the Fed's goal. Chair Powell is remarkably clear on what he wants to accomplish. And it's not inflation per se or killing inflation. It's a much more simple fact. It really bugs him and it worries him that there's 11 million job openings in this country and only 5.5 million unemployed people. So if you employed every single unemployed person with a job opening currently posted, you'd still have a missing gap of 5 million people. And that's what really gets to him, because he sees that as causing wage inflation. And whenever he talks about this topic, he's not talking to us in capital markets. He's talking to corporate America and basically saying, I'm going to keep raising rates and keeping the stock market volatile until you understand that you have to stop posting so many jobs and trying to hire so many people. That's driving wage inflation. What Chair Powell wants is basically a hiring freeze. He wants corporate America to stop hiring, because that'll defeat the wage price spiral and hopefully bring inflation down. And that's not anything people often say, but in the spirit of this conversation about keeping things as simple as possible, that is the simple fact. We need fewer job openings. We need corporations to stop trying to hire everybody else's workers and giving everybody 10% pay increases to switch jobs. That has to stop. And Powell is being very clear to corporate America, saying, I'm going to keep doing this until you stop. They haven't really stopped yet, but I think it's coming. And then one number I would tell you to focus on is initial claims. Every Thursday morning you get initial claims. Those are at crazy record lows, like 200,000 initial claims a week. That was the number in 1969, not adjusted for population growth. So we have twice the number of workers then as now, and our initial claims number is as low as it was then. So expect those to rise very quickly, and expect the financial media to get all over that topic and say, oh, we're heading into a recession. Maybe, but maybe not. And the answer is more in that that is the stated goal of Fed policy. 10-year interest rates, let's just touch on those very briefly. If you had to guess, what would you say is the, say, 10 or 20 or 50-day price correlation between 10-year treasuries and stocks? So how often do those things move together? Think about that question. And I think most of you would say, well, probably pretty high, right? Maybe 30 or 40% R squared, just thinking about how rates are affecting stocks. The actual answer is 0. If you just go to your, go pull the data and run the spreadsheet, 10, 20, 50, 100-day rolling price return correlations for TLT versus IVV, or pick your other favorite S&P ETF, is 0. The R squared is 0. It's just that it's usually negative 40%. That's why it feels so much more tightly correlated. So the bottom line there is don't expect lower rates, which I think are going to come in the near term because the market's so volatile. Don't expect those to save the equity market because the price return correlations just aren't there to prove that it will happen. It might help at the margin, but at this point, lower rates says, yeah, recession's coming. And stocks probably go down with them as well. Oil prices. Let's keep things simple there as well. Go look at a price chart of oil, right? And even if you're not a chartist, you understand the trend. Oil prices are going higher. We have been telling clients the only thing to own overweight right now is energy. I've been saying that for the last 3 months. And for a very clear reason. When you have a war, oil prices go up. I mean, I'm old enough to remember the 73, 74 recession and oil prices and hearing my dad swear at the gas pump every week for a year and a half. And that's what's happening now. We're getting an oil price shock. They happen once in a while. The key number to watch, again, in the spirit of keeping things simple, is whenever you have oil prices double in a year in this country, you get a recession every single time. And it's not just oil shocks. It's also like in 2000 and 2008. Oil prices spiked in a commodity supercycle and a recession came. Now, for partly other reasons, but if you get a double in oil prices, you get a recession. Always happens, probably always will. The other issue with Russia-Ukraine is obviously the euro. I don't know how many of you think about currencies in the context of how you invest, but go look at a chart of the euro. The euro is at 105. It's going to par. It was 122 a year ago. That's the decline in the euro. That tells you Europe is going into a recession, no doubt about it, because of the uncertainties of the war and because of higher oil prices. And then again, keeping things simple, when the euro can stabilize, then I think it's okay to buy European equities, but not before. Other rules about keeping things simple, and this is more a combination of like just stuff I've learned over the years and stuff I learned with Steve. And I'm always surprised that, well, I'll just give them to you and you see what you think. My number one rule in investing across the board, always, is you don't sell new highs and you don't buy new lows, ever. So if a stock is making a new high and you own it, keep owning it. Don't short it if you don't own it, by the way. And if a stock is making a new low, 52-week low, do not touch it until it stabilizes, period. Particularly in this kind of market, those are the golden rules of investing. You're not smarter than the market. And back when I was in business school, we had this interview question that people would love to ask. How many days can a stock go down 10%? And the answer is infinity. It can go down 10% for as long as you live. And I've had too many friends over the years blow up their careers trying to bottom feed on stocks, so I really embrace don't buy a new low. Now, if you want to short a new low, then there's a wealth of ETF products out there, like the Short Arc ETF and a bunch of others that I think are very clever at being able to speculate on how much lower things can go. But that's a very, very important rule right now. The other things that I use statistically, very simple things, the VIX. So the VIX mean back to 1990 is 20. That's the average across all cycles. Standard deviation is 8. So the trigger points where the VIX makes stocks look interesting are 28, 36, 44, and 52. That's 1 through 3 standard deviations away from the mean. And I don't get interested in stocks at these levels until the VIX hits 36. And it did so once this year on the close on May 7th, and the bottoms were May 8th and I think March 14th. So the VIX works as a short-term signal, but until it gets to 36, I would not be buying anything. And if it gets to 44, then you can really be assured you're starting to get a flush. Down years, another basic rule. So I think at this point it's very clear we're going to have a down year for the S&P. I think we'd all agree with that. So if you go back and look at every down year since 1958 when the S&P was first put out there, the earliest bottom for a year is June, and that was in 1962. And they typically bottom more like in October to December. So if we're having a down year, and we are, then history says you can sort of take the rest of the month off, don't buy anything. June is the earliest, and even that's a little bit shaky because it only happened once, and in general the lows are October to December. Now, every time is different, everything is different, maybe things could change, but just keep in mind that the historical record is really clear. Down years don't bottom in April or May or March. They bottom later in the year because it just takes time for the market to discount next year's earnings. That's it for my sort of simple comments. I want to close on something else. For those of you that maybe that know a little bit about Steve and know a little bit about SAC, you might know that he had a psychiatrist on staff. And the psychiatrist, if you were new, like when I started there in 1999, I'd spent 9 years analyzing the auto industry at First Boston, so I was new to trading. So I had to sit with the shrink every week for the first year. And brilliant guy, Ari Kiev is his name, or was his name. And he wrote a bunch of books about his time at SAC. And he began every conversation with the same questions. Okay, what did you trade this week? Now tell me about 1 or 2 trades. And he would focus on how did you feel at the time? Like, how did you physically feel? And I always thought when I was doing it, like, oh, that's just the usual sort of shrink mumbo jumbo. How do you feel about this? And then many years later, I read about an academic study called the Iowa Gambling Test that actually had a group of subjects go through a basic gambling exercise or picking cards from a deck. And there were some good decks to pick from, some bad decks to pick from, and they didn't know which ones they were until they tried a bunch of times and kind of hunted around and found the good ones. And the trick was that the subjects were wired up to like a stress monitor, like breathing and galvanic skin stress. And what the researchers found was that the subjects knew they were hovering over a bad deck long before their brains let them understand that that was a bad deck. So if they had to pick like 20 decks, 20 pulls to see which decks were better than others, their bodies started to get stressed when they hovered over a bad deck at around the 8th or 9th choice. But they kept picking the bad ones because their brains weren't letting them acknowledge what their intuition was saying. And it was a very powerful point, and I think about it a lot to this day. Intuition is a hugely important part of what we do. You can't just go off and willy-nilly guess and say, oh my God, I hope, Carvana or Tesla bottom here and, let's get long, the NASDAQ, or let's get long ARK. That's not the point. The point is you still have to have a lot of expertise, but once you have that, your intuition is a very powerful tool that allows you to both avoid mistakes and really understand what's a good idea and what's not a good idea. And intuition is something that I think we all kind of dismiss because particularly in markets like this, fear is sort of our overwhelming intuition. But it's important to understand, like, you do know a lot about the market. You do understand a lot about investing. And adhering to a process where you think about how do I feel about what I'm doing? How do I feel about the positions I have? How do I feel about what I'm telling clients? And when that intuition says you're right, you're probably right. And don't fight it. It's very hard to do, but it really comes down to like what Ari used to tell us, which is literally listen to your body and listen to what you're physically thinking and feeling, and that will help. And that's perhaps the simplest thing I can share with you is keeping it simple means ultimately, following your process, but also recognizing that your intuition, has a lot to say as well. So that's 20 minutes. I guess we have a few minutes for questions if anybody has a question.
Hey, Nick, I studied a lot of your work from Convergex. Very big fan.
Oh, thank you.
Thanks for that. I just want to touch on 1 or 2 things, and then I do have a question. You mentioned the S&P and the revenues. I think it's super interesting that in between 00 and 15, Microsoft and Cisco had 4x revenue jumps, and Microsoft was flat and Cisco was down 50. So I think that's super important. And you mentioned the Fed, and I think that for the last bunch of years, right, everyone was not fighting the Fed by buying stocks, and now the Fed has told everybody what they're doing, and those buying stocks here are sort of fighting the Fed now. I think that's a real interesting point. I wanted to ask you, a lot of the smarter guys I've been chatting with have that similar view that you do. I wondered, you talk to probably a lot of people, do you think that the bulk of the bigger stock holders have the view that you have proliferated here? Because I hear from a lot of people, they're refusing to sell those big stocks. And I wondered if you felt the same. In other words, like econ recession has been talked about. I don't know as much about the EPS recession, which Walmart and Target have just shown us. I wonder if you feel there's still people hanging on to the legacy longs, and that's sort of why we're not getting that flush. I just wondered.
Yeah, no, it is exactly the right point. I think about that a lot. And I'll put it to you this way. Just put yourself in a big portfolio manager's shoes. Okay, you're down 20% on the year. You're probably down a little bit more than the S&P. Okay, fine. If you start to puke out here, what happens if Putin all of a sudden goes away, or Russia-Ukraine becomes materially better, and oil prices go from 115, 120 back to 80, and you get this massive 20% reversal on the S&P? Can you afford to miss that move? Because if you've taken this pain, this is, like what's lesson number one in business school? Sunk costs are sunk, like the past is irrelevant. But people still anchor on the past, and people just refuse to take losses. It is, in many ways, the biggest rookie mistake in investing is not taking a loss. So I think they think about it in terms of not just, I don't want to take a loss, but it's also, what happens if something good happens? What happens to markets if something good happens? Because selling here or reducing risk exposure here is an implicit bet that the next 3 months are going to look a lot like the last 3 months. I think honestly, it's a fair bet, because let's just do some basic math. The S&P topped out pre-pandemic at 3387 in, I think, early February of 2000, and the S&P was earning $160 a share. So those are the numbers, okay? S&P is now earning $220 a share. And the typical recession has a 25% reduction in earnings, S&P earnings. That's the average over the last 4 cycles. Some are worse, some are better, but 25 is a good average. 25% off of 220 is $160. Exactly what we earned at the peak of the last recovery. And the S&P was 3387. We're obviously higher than 3387 right now, and rates are going up versus the last cycle where they were very, very low. So you can tell a very logical story about why you should continue to be cautious here. But I manage money. I totally respect the fact that it is super hard to get bearish here if you've been positive all the way through. Because what if something good happens? I'm going to miss out. So everybody's got to sort of deal with risk the way they see it, right? But I'd be a seller, but I totally understand why some people aren't. And if you've got if you've got fantastic political connections in Russia and know that things are going to change during the next month, then first of all tell me, and then get super long, because that's about the only hook.
Any more questions?
Cool. Thanks so much.